Okay, so loans and loggers. We are talking mortgage questions. We're here at Westbound and Down Brewing in Lafayette. This place is great, and we're really thankful to them for having us. They have great beer and great pizza, and we're just going to get into some loan questions. So I'm here with Pete Sola of Spire Financial. He's my go-to guy in the mortgage business, and we're gonna answer your questions today. So Pete, cheers as we get started. So we're gonna kind of go an intermediate level of question here because basic stuff. What is a pre-approval? You can find that information anywhere. People who watch this channel have seen me talk about it enough. We don't need to talk about that. But when you're getting into the loan process, there's some things that aren't very obvious, and some people want to know. So when you're getting someone approved for a loan, when you are doing that mortgage application process, what are the main things you're looking at?
Well, I would say there's 4 key areas that we look at. That's a client's debt, income, savings, and credit. So those 4 things are the most important things. So the way that you can remember it is DISC, D-I-S-C, debt, income, savings, and credit. Okay. When it comes to debt, that's obviously the biggest thing. We look at your debt to income ratios. Make sure you fit within the box that we're given. With debt, we're going to look at car debt, credit cards. If you own multiple properties and you have multiple mortgage payments, we're going to take all of those debts into consideration, and we're essentially going to compare it to your income. And income is obviously the next piece. We're going to talk about, are you a W-2 employee? Do you making a salary? Are you making commission? Are you self-employed? That's a big one. Multiple things that we look at on the income portion of it, but debt to income ratios is obviously the biggest piece of that. The next one is savings. There's some clients that have a lot of money. There's some clients that don't have a ton of money, which is totally fine. It's case by case. But we got to know what kind of budget we're working with. We want to know what your goals are. Do you want to put a lot down or keep more in your pockets? Savings is a big piece of the mortgage process. What are we looking at? How much cash do we have? And then obviously one of the biggest pieces too is credit. There's multiple different tiers of credit. If you're over 740, it's considered excellent credit. If you're in between 740 and 720, it's considered still good credit. Below 720 to 700's still good credit as well. But once we creep below those 700 marks, it's considered fair. And then once we get down a little bit lower, it's there's going to be some repairs that we're going to have to make.
The pre-approval, everybody knows. I say this is basically the first step in house hunting. You need to get pre-approved, so we have that in place. Now everybody wants to know, once I am pre-approved by Spire Financial, how long is that pre-approval good for? How long does it last?
So the answer would be 120 days. So it goes from when we actually do a hard pull on credit. You have 120 days from that moment in time to essentially, be pre-approved during that time frame. Now, if it expires, all we have to do is another credit pull. But obviously, if we're past that 120-day mark, you're gonna have another inquiry on your credit report, so it could ding you just a little bit. But if you do have good credit, strong credit, an inquiry's not gonna be super substantial in regards to a loss of credit.
The hard credit pull is a big one people want to know about because, it's going to ding my credit. If there's ever a time to do that, it's probably when you're applying for a mortgage to buy a house. But is that going to hurt your credit? What if we have to pull that credit again? What's going to happen there?
Again, it kind of just alludes back to if you have over 740 credit and it's not going to be that big of a deal. Where we could run into issues is if you're applying for multiple lines of credit. So if you're looking for a house, if you're looking for a new car, if you're trying to finance a boat, if you're trying to open up another credit card, and you have all these different avenues where they're taking hard credit pulls, that's when you can kind of see those things start to shift along the credit score. So
the big thing everybody always fixates on is interest rate, right? That's in the news, and it goes up, it goes down. There's not a whole lot we can do about that, but everyone's trying to get the best rate. So the rate is going to be what it's going to be. But other than that, what are some other things to look for when you're applying for a loan?
Yeah, I think the most important thing is having a good advisor someone who is really taking you and I wouldn't say necessarily holding your hand, but advising you. You shouldn't be making a financial decision just based off of just the lowest rate possible.
Yeah.
There's actually even benefits for taking a higher interest rate, because sometimes taking a higher rate can result in rebates that can help cover closing costs. So when I talk with clients, that's what I'm talking about with them is, or what I'm discussing with them is, what's most important to you? Is it the monthly payment? Do you want to get it as low as possible? Here's what the monthly payment would be, but there's also different things that you can do to lower your monthly payment, like mortgage insurance.
Yeah.
Mortgage insurance, if you put less than 20% down, technically you have to pay mortgage insurance on that, right? But there's also other options of, single premium mortgage insurance, where you can actually buy out the rest of it and eliminate the monthly obligation. And sometimes if debt to income is, super tight and it's pushing that limit of possibly not qualifying for the mortgage, by doing a single premium option, you can actually just buy out the rest if you have a little bit of cash and just buy it out, pay for it, and you don't have to worry about it, and it lowers your monthly payment, which is nice.
Yeah.
But also, when discussing with clients, values and what's important to them is, how much do you want to spend? Oftentimes people just think, and I get it all the time, is I need 20% down. Well, it's like average home price in Denver metro area is about $650,000.
Not 30 grand.
Not a lot of people have $130,000 in liquid cash.
Right, I know.
Right? It's ridiculous. So as a buyer, you can put all the way down to 3%. 3% down, 5%
You've done that for
down.
my clients before. We've
Yeah.
done 3% too.
Yep, we've done 3%. We've also incorporated a down payment assistance loan. So that's what goes back to, discussing with the client, oh, hey, I don't have a lot of cash. I maybe only have sometimes $5,000, $10,000, 15, whatever it might be. A rate's a rate, but if we can incorporate, a down payment assistance loan with it as well, then the client doesn't have to bring, $30,000, $40,000. Maybe they can bring, much less than that.
So we talked about credit before. That's one of the things that is obviously going to factor into your approval process. If somebody doesn't have very good credit, what can they do to strengthen that over the next, say, 6 months to a year?
Yeah, well, and one thing I'll say about that too is if credit's not where we're anticipating it, there are different programs out there, like government loans, such as FHA, for example. They can go all the way down to a minimum FICO score of 580, which is awesome. But in order to strengthen your credit, I think one of the most important things is we look at those debt obligations, right? If you're maxing out your credit cards every single month and just spending a lot of money, keeping that super high balance, you gotta pay off those debts, those credit cards, and get it below a certain threshold. Basically, generally for credit cards, for installment debt, you want to have below 35% utilization, and that'll dramatically boost scores. Also, another thing people run into, life happens, right? Sometimes you gotta go to the hospital. There's a bill that's outstanding. You might be hit with some sort of medical collection. Collections pop up all the time. You just got to make sure that it's either paid for, or if it's already been paid for, you want to make sure that it's just not on the credit report, which that's the importance of doing a hard pull of credit, is we can see everything on that report. And if something like that, like a collection, pops up, we know the necessary areas for you to go to get it disputed, or figure out some sort of way that we can pay it off or get it taken care of before we actually give out a pre-approval or close on a home. And one thing I'll say about that, just another thing, is if you don't have any credit established whatsoever, say mom and dad, or aunt and uncle, grandma, grandpa, somebody who does have good credit, a person that's looking to buy can actually join as an authorized user on a credit card. And essentially it's just you're liable for the debt as well for that person who's essentially on the credit account with you. But as long as you're on that as an authorized user, and you're at least on it for 30 to 45 days, you can actually generate credit scores after that time frame, between 30 to 45 days.
Beautiful.
by just joining someone's credit card. So say if I had no credit, I could essentially join your account. As long as you're making your monthly payments, every single month, it'll actually give me credit for that.
And finally, it's no secret, I've talked about this plenty of times. This is a very strong seller's market. It's very tough for buyers. It's extremely competitive, and it's really hard to get buyers under contract. As a realtor, I'll have my bag of tricks. I'll do what I can and make the strongest offer possible. But as a lender, you guys also have ways that you can go to bat for the client.
So Spire's bread and butter over the, since its existence back in 2004, 2005, is we've always done a full credit underwrite up front. And essentially what that means is we put you into underwriting immediately to get that process started, eliminate those timelines of, the week, 2 weeks that it takes for an underwriting process. And we try to get that eliminated like up front. So we go through what's called a full credit underwrite, which is also known as Spire Key Approval. We need our borrowers to be Spire Key approved in order to put in like a non-contingent offer, for example, where we can eliminate loan contingencies out of the contract and actually have our offers look like cash. Spire has actually announced that we have a full cash offering program. Cash offer, our buyers can actually offer cash. Now, in order to qualify for that, obviously there's a lot of things that go on within it, but you have to have the full Spire Key approval, the full credit underwrite that I was just alluding to. That's what we need in order for you to be in a position to where we could actually utilize our cash buyer program, where Spire can literally buy the house in cash, and then obviously we can give it back to our borrower because they've already had the loan underwritten and it's good to go. We have a fiduciary duty to make sure that our clients' money is safe and make sure that our borrowers are in a good position that's going to benefit them for the future. Colorado's a great state. Denver's a great city. So many people are moving here, and it's been such a hot market for so long. We want our people that live here or that are moving here to reap the benefits of the beautiful weather and the 4 seasons that we have. We really just want to make the experience of the home buying process incredible, and that's what Spire Financial does.
All right, buddy, this has been a pleasure. Yeah, so love it. We'll get together and talk again, but one final cheers.
Thank you.